Real estate isn't just about buying a home and hoping it goes up in value. For decades, investors have tried different ways to tap into the income and growth potential of commercial properties, from office buildings and hotels to retail centers and apartment complexes. But what if you don't have the capital to buy an entire warehouse or the time to manage a rental property? That's where real estate investment trusts, better known as REITs, come into play. They allow everyday investors to own a slice of large scale real estate ventures without ever picking up a hammer, finding tenants, or dealing with property taxes directly. Think of a REIT like a mutual fund focused on property. Instead of holding stocks or bonds, a REIT holds a portfolio of income producing real estate. This could be anything from a set of bustling shopping malls, a collection of apartment complexes, or even data centers that house digital infrastructures. By buying shares of a REIT, you essentially become a part owner of all these properties. The best part, REITs are legally required to distribute a significant percentage of their taxable income to shareholders as dividends, often at least 90%. This typically means a steady flow of income for investors. And because many REITs are publicly traded on stock exchanges, buying or selling them is as easy as trading shares of any blue chip company. No negotiating with landlords, no calling a plumber at midnight, and no chasing down late rent checks. Of course, you are still affected by the ups and downs of the real estate market, as well as interest rate shifts, property taxes, and economic trends. But for many, the convenience and potential steady income stream outweigh the volatility. Ultimately, rates simplify real estate investing. They remove the high barriers to entry, like massive down payments or personal property management, and they let you diversify your holdings without becoming a full time landlord. Just remember, not all rates are created equal. They come in many forms, focusing on different property types and regions, each with its own risk and return profile. Before you invest, take the time to understand what kind of properties a REIT owns, how it's managed, and how its dividend payouts have performed over time. Done right, REITs can be an accessible, flexible tool to add real estate exposure to your portfolio. And remember, real estate wealth awaits those who invest very wisely.